Most people think insurance companies calculate your price after you apply. You fill out a form, answer a few questions, and then they determine your risk. But that's not actually where the process starts anymore, because companies like LexisNexis Risk Solutions and Verisk Analytics have already been building a profile on you long before you ever request a quote. These companies aggregate data from multiple sources tied to your identity. That includes public records, prior insurance claims, property data, and behavioral signals linked to transactions and location patterns. This information is compiled into structured reports that insurers can access instantly, meaning your risk profile already exists before you interact with them. One of the most important systems feeding this process is the CLUE report, or Comprehensive Loss Underwriting Exchange. This database tracks insurance claims associated with your name and property, often going back several years. Even claims that were denied or inquiries that didn't result in a payout can still appear, influencing how your risk is evaluated. Then there's the FICO Insurance Score, which operates differently than a traditional credit score. It uses financial behavior patterns, payment history, debt structure, and credit usage to predict how likely someone is to file a future claim. It's not measuring your ability to pay, it's measuring statistical probability based on patterns seen across large populations. Beyond financial data, insurers are increasingly using telematics programs like Progressive Snapshot and Allstate Drivewise. These systems collect real-time driving behavior through mobile apps or in-car devices. Speed, braking intensity, time of day, and frequency of trips are all recorded and fed into predictive models that assess future risk. All of this data flows into actuarial algorithms designed to classify risk across millions of profiles. These models don't evaluate you as an individual in isolation. They compare your behavior to large datasets, identifying patterns that correlate with higher or lower claim likelihood. If your profile aligns with higher risk patterns, that classification can directly impact your pricing. What makes this system difficult to recognize is that it operates before you ever engage with it. By the time you request a quote, much of the evaluation has already happened. Your data has been collected, your behavior has been analyzed, and your profile has been placed into a risk category based on predictive modeling. And like many data-driven systems, the inputs are not always transparent. You may not know which data points are being used, how they are weighted, or how accurate they are. But the system does not require perfect accuracy. It only needs enough predictive confidence to assign you to a category that can be priced accordingly. In some cases, consumers can request access to certain reports or dispute errors, but the data is fragmented across multiple organizations. LexisNexis Risk Solutions holds one layer. Verisk Analytics holds another. Credit bureaus like Experian, Equifax, and TransUnion contribute additional financial data. There is no single place where the entire profile is visible. So what looks like a simple insurance quote is actually the final step in a much larger system. One that begins long before you apply, runs through multiple data pipelines, and produces an outcome based on patterns you may not even realize are being tracked. And once that system has classified you, it can follow you across future decisions. If this video opened your eyes even a little, don't let it stop here. Hit that subscribe button because the next one goes even deeper. Hit the like button so this video actually reaches more people. Go to the comment section and let me know what stood out to you or what I should test next. And share this video with someone who needs to see it before they scroll past it. Because the more this spreads, the harder it becomes to ignore what's really going on. Are you ready for the next truth test? Let's go!